Hello and welcome to StudyIQ. In this lecture, we will discuss about GVA and GDP, that is Gross Domestic Product and Gross Value Added. Why this has become an important current affair is because recently the Deputy Governor of the RBI made an announcement that the central bank would be moving back to GDP for the calculation of national income. So before making a comparison between the GDP and the GVA, let us first see what are these two terms. First, let us discuss GDP, Gross Domestic Product. We have already seen in a previous module of national income what is GDP and the definition of GDP. But for your understanding, I'll explain it again. By definition, GDP or the Gross Domestic Product is the total monetary value of all the goods and services produced in an economy in a financial year. Here in this definition, some terms are very important. First one, final goods and services. It means that only the final goods and services are taken into consideration, which means the intermediary goods are excluded. So the first important term is final goods and services, which means intermediary goods are excluded. Second one, produced in an economy. This is very important. In gross domestic product, GDP, the word domestic is given the importance, which means that those goods and services which are produced inside the economy or inside the domestic territory of an economy is given importance. So this is the most important term here, which means that when you calculate GDP, only the goods and services which are produced inside the domestic territory of a country is included. Third one is financial year. So the time period is one financial year. In India, a financial year begins on 1st of April and ends on 31st of March. And financial year is also known as accounting year. Now let us see these terms in detail. The first one, final goods. As you all know, goods are of two types. One is final and second one is intermediary goods. Final goods can be again subdivided into capital goods and consumer goods. So what are final goods? Final goods are those goods which are ready for consumption or ready for use. Intermediate goods are those goods which will help in the production process, or they cannot be directly consumed but they will help in the production of a other commodity. Example is raw material. And we said final goods can be again divided into capital goods and consumer goods. Capital goods are those goods which will help in the production process. Example, machinery, which means that they will again produce. Those goods are capable of producing again and again or giving output. And what about consumer goods? Consumer goods means those goods which are consumed. Example, bread. Now let us see some examples. Sometimes final goods can be intermediate goods. Let us see how final goods become intermediate goods. Let us take the example of milk. If you purchase a packet of milk, suppose a household or an individual purchases a packet of milk to make tea in his home, it is a final good. How? Because that family will make tea and they will consume it themselves. So it becomes a final good for that household. But if the same packet of milk is purchased by a hotel, it becomes intermediary good. How? This chaiwala will make tea out of that milk and they will sell the tea. So it becomes a intermediate good. And what is their final good? Tea is the final good here. Milk is not the final good because they uses it as an intermediary to make tea. So tea is the final good and milk here becomes intermediate good. So for the household, milk is the final product. Also in some cases, consumer goods become capital goods. Let us see how. Example, car. If a family purchases a car and uses it within the family, it is a consumer good because the car is used by the family for their personal use. So this is a consumer good. The family consumes or utilizes the car. It becomes a capital good when a person purchases car and converts this car into a taxi. So If the car is used as a taxi, it becomes a capital good because this car will be used in the production process. What is the production here? It is the production of services. So taxi is a service and this same car will be used as a taxi and services are provided. So this becomes a capital good. Hope this is clear for you. The next important term is in an economy or the domestic territory. What does a domestic territory mean? Domestic territory is not only the political boundaries of a country. So domestic territory means political boundaries plus something. What is this something? This will include embassies, consulates and military establishments abroad, ships, aircrafts or shipping vessels which are owned by the residents of the country. So domestic territory is beyond political boundaries. All these are included in domestic territory. The next important term here is financial year. We have already said that financial year is also known as accounting year, and in India it begins on 1st of April and ends on 31st of March. Now let us see some important concepts. The first one is gross versus net. When you purchase a capital good, for example machinery, suppose you have purchased the machinery in the year 2015 and this is 2018. Do you think the machinery will have the same value when you purchased it in 2015? No. The value of the machinery would have come down. Why? This is because of depreciation. So what is depreciation? Depreciation is the wear and tear that happens to the capital goods over a period of time. So depreciation. And we have already seen what is GDP. GDP is gross domestic product. So it is a gross concept. And if we deduct depreciation from GDP, we will arrive at NDP, which is net domestic product. NDP is nothing but depreciation is deducted from GDP to arrive at NDP or net domestic product. Next concept is factor cost and market price. What is factor cost? Factor cost is the cost incurred on factors of production. So the cost incurred on factors of production is known as the factor cost. What are the factors of production? They are land, labor, capital and entrepreneur. So these factors of production require some remuneration. So what are the remuneration? Land rent must be given, labor wages are provided, interest is provided to the capital and profit is given to the entrepreneur. So these four things together culminate to form cost on factors of production. So this is known as cost on factors of production and this is known as the factor cost. So cost on factors of production is called the factor cost. And if you add net indirect taxes to the factor cost, we will get market price. So what is market price? Market price is factor cost plus net indirect taxes. So what is this net indirect taxes? Let us see. Net indirect taxes means indirect taxes minus subsidies. So indirect taxes minus subsidies will give you net indirect taxes, and if you add net indirect taxes to your factor cost, we will derive at market price. And GDP at factor cost and GDP at market price is very, very important. Let us see that through an example. Let us take 2 years, 2016 and 2017. Here, production, factor cost, tax, market price, GDP at factor cost, GDP at market price. Suppose in the year 2016 the production was 100 units, the factor cost was 10, tax was 1, so market price equal to factor cost plus net indirect taxes, so 10 plus 1, market price is 11, GDP at factor cost, production into factor cost 1000, GDP at market price, that is production into market price, that is 100 into 11, 1100. Again coming to the year 2017, production 100 units itself, factor cost also 10 rupees, tax increased to 3 rupees, so market price is factor cost plus tax, that is 13, GDP at factor cost 100, production 100 into factor cost 10, that is 1000. And GDP at market price 100 into 13, that is 1300. So now let us consider this example. You will notice that in the 2 years, that is 2016 and 2017, the production is 100 unit. That means the production in the economy has not increased over 1 year. So production is 100. 100 in 2016, 100 in 2017. Factor cost is also the same, 10 rupees. Factor cost is 10. What has changed? The tax has increased. In 2016, the tax rate was 1 rupees and in 2017 it has increased to 3. So because there was an increase in tax, what happened? Market price increased. What is market price? Factor cost plus net indirect taxes. So because the tax increased, you will see that the market price was 11 rupees in 2016. It increased to 13 in the year 2017. Why? This is because of an increase in the tax rate. Okay, coming to GDP. GDP at factor cost is production into factor cost. It is 1000 units. It is 1000 in the year 2016 and also in the year 2017 you will see that GDP at factor cost is 1000. What has changed? GDP at market price. So GDP at market price was 1100 in the year 2016 when the tax rate was 1 rupee and market price was 11. In the year 2017, GDP at market price increased to 1300. Why? Because market price increased to 30. Market price increased to 13. Why? Because taxes increased to 3. So from this example, what can be the conclusion? We can conclude that if taxes in the economy increases, this will result in increase in GDP at market price. So GDP at market price can increase with an increase in the tax rate in the economy. So can you say that there is growth in the economy if GDP at market price has increased? No. You cannot measure growth in the economy using GDP at market price because this can simply increase because there is an increase in tax rate in the economy. So this does not mean there is growth in the economy. So this is not an indication of growth in the economy. This concept you should be very clear of because as we proceed with this module, this understanding is very necessary. That's why I have given you an example and explained this concept. So this is a very, very important concept. You should have clear understanding. Now let us see the third concept, that is current price and constant prices. Current prices means that goods and services are calculated or valued at the same year prices. Same year prices are taken into consideration. Constant prices means that the value is based on a base year price. So what is a base year? Base year is a normal year without much inflation in the economy. So this is a normal year without much inflation in the economy. I will explain to you the concepts of current prices and constant prices through an example. Let us take 3 years. Year production, current year price, base year price, GDP at current prices, GDP at constant prices. Okay, let us consider 3 years, 2014, 15, 15, 16, 16, 17. So production for the year 2014-15 let us assume as 100 units. Current prices 10, base year price also 10. So GDP at current prices will be production into current price, that is 1000. GDP at constant prices will be production into base year price. GDP at constant prices will be production 100 into base year price, that is 10, that is 1000. So coming to the next year 15-16, 2015-16, assume that production was 100 units itself, but the current year prices increased to 15. Earlier it was 10, now it is 15. Base year price is constant, so it is again 10. GDP at current prices will be production into current year price, that is 1500. GDP at constant prices, production into base year price, that is 100 into 10, that is 1000 again. Coming to the next year, that is 2016-17, production increased to 150. Let us assume that the production has increased from 100 to 150 units. Current year price is the same, that is 15 rupees. Base year price again it is 10 because it is constant, GDP at current prices. GDP at current prices is production into current year price, that is 2250. GDP at constant prices, production 150 into base year price, that is 1500. Now let us see. In the year 2014-15, production was 100 units, current price 10, base year price 10. So GDP at current prices is 1000 and GDP at constant price is also 1000. That means GDP at current price and constant price is the same. Why? Because the current price and the base year price was the same. Coming to 2015-16, the production is still 100 units itself. There is no increase in production. Current price is 15, which means that the price or the current price has increased. Earlier it was 10, now it is 15. And base year price 10 itself. So GDP at current price increased from 1000 to 1500. Why this happened? This happened because the current prices increased. So what is current price? The existing price in the market. So in the market the prices has increased from 10 to 15, which increased the GDP at current prices. And GDP at constant prices is same because the base year price is not changed and production is also the same. What can be the conclusion from this? We can make a conclusion that GDP at current prices can increase because of increase in the current year prices. GDP at current price can increase because there is an increase in the prices of commodities in the market or with an increase in the current price in the market. Why does the current price in the market increase? Current prices in the market increase due to a phenomena called inflation. What is inflation? Inflation means a persistent rise in the prices of commodities in the market. So, due to inflation, the current prices in the market can increase. And due to that, GDP at current prices also can increase. And what is the understanding? Production will remain the same. GDP at current prices has increased. There is no increase in production, but GDP increased due to inflation. This is the conclusion. Now coming to the third year, that is 2016-17, you will see that the production has increased. The production has increased from 100 to 150. The current prices is same as in 2015-16. 15 rupees in 15-16, again 15 rupees in 16-17. Base year price, as we said, it is the same. So let us come to the GDP. GDP at current prices is production into current price 150 into 15, that is 2250. GDP at constant prices, production into base year price 1500. See, what you will notice here is that the GDP has increased comparing to 15-16. In the year 16-17, the GDP at current prices as well as GDP at constant prices has increased. So, what does this mean? It means that the production has increased, therefore the GDP also has increased. So, we can arrive at another conclusion, that is the GDP will increase because of increase in production. So, here two conclusions. The GDP at current prices can increase due to two reasons. One is an increase in cost or an increase in the prices, that is inflation. GDP can increase due to inflation and also due to an increase in production. I hope now you also know why base year prices is taken into consideration while calculating the GDP. Because of the influence of inflation. Now I hope GDP and its associated concepts are clear for you. Now let us see what is GVA or gross value added. GVA. GVA refers to the total value of output in the economy minus intermediate consumption or total output less intermediate consumption. We have seen that GDP is the total monetary value of all the final goods and services produced in an economy during a financial year. But when it comes to GVA, it is the total output. What is total output? It is GDP. So what is total output? It is GDP. So GDP minus intermediate consumption will give you GVA or gross value added. Let us take an example. Suppose the value of a final output is rupees 25. This is the value of final output. And suppose rupees 15 is the cost of intermediate consumption. So 25 minus 15 will give you 10, and this is value added. Rupees 10 is the value added here, and rupees 25 is the final output, which is the GDP. So GDP minus intermediate consumption will give you value added of a commodity. Or you can also say that value added plus intermediate consumption will give the GDP. So what is GDP? Value added plus intermediate consumption. So what is the significance of value added? This represents the contribution of labor and capital in the production process. So this is the contribution of labor and capital. Now let us see whether we can arrive at a connection between GVA and GDP. So what is the connection? Let us see. Suppose a bottle of apple juice. The cost is rupees 30. 30 rupees. This means that rupees 30 is the total output or the monetary value of the total output. So value of total output is 30 rupees. And how did we get this total output? When you produced this one bottle of apple juice, there were many intermediaries. So when you produced this one bottle of apple juice, there were value addition in many stages. So value addition was there in many stages. And if you club together all these value additions that happened in different stages of production, you will get GDP. This means that you can arrive at GDP by adding value addition at different stages. So this will be gross value added. How? There will be value additions at different stages of production. And when you add all these value additions, you will get GDP or the total output. So GDP is a culmination of various value additions at different levels of production. Hope this idea is clear for you. One thing that you should notice in GVA is that depreciation is not considered. So depreciation is not calculated or depreciation is not adjusted in the calculation of GVA. We have already seen what is depreciation. So you must understand that both GDP and GVA are tools to measure economic growth in a country. So GDP and GVA both are tools to measure the economic growth in a country. But GDP is the monetary value of all the final goods and services produced in an economy, while GVA is merely the value added. That means intermediate consumption is reduced. So this is the total output. Now let us see what are the differences between GVA and GDP. One major difference between GDP and GVA is that GDP measures the economic growth from the consumer's angle or from the consumer's side, whereas GVA or gross value added measures the economic growth from the producer's angle. So this is one major difference. So GDP comes from the consumer's angle. Why? Because it is the monetary value of total final goods and services or the total output, whereas GVA is value added. So it is calculated from the producer's angle. Another important difference is that GDP gives an overall figure of economic growth, whereas GVA gives a sector specific view, whereas GVA gives a sector specific picture. So coming to GDP, GDP shows an overall growth picture of the economy. It does not show sector specific. But coming to GVA, this can bring a sector specific picture, which means that GVA can bring, for example, GVA can bring out data relating to the growth of different sectors, which sectors have shown improvement or which sectors have come down. What is the growth in agricultural sector or what is the growth in industrial sector or different categories. So this will bring sector specific pictures, and this sector specific picture is very necessary for making policies by the government. Why? Because the weaker sections need to be given more attention. So the policy makers can decide which sectors need stimulus or incentives. In such a way, GVA is very important. But when it comes to GDP, what is more important here? GDP is a key measure in comparing the performance of an economy with other economies. That means cross-country analysis. So GDP helps in cross-country analysis. If you want to compare the Indian economy or growth in Indian economy with that of other economies, This is important. GDP is a key measure for that. In the beginning of the discussion, we have already said that this is an important current affair because the RBI Deputy Governor Viral Acharya has recently made an announcement that the Indian economy would be moving back to the GDP calculation. So, we need to understand why we are going back to GDP. So, for that we must understand what are the reasons for that, and Deputy Governor himself has given certain reasons. Let us see one by one. The first reason he had given was that in order to conform with international practices. This means that globally many economies have adopted the GDP model of calculation of income and growth. So this is an international practice and we need to comply with it or conform with it. That's why we are moving back to the GDP or gross domestic product. The second reason he gave was due to the ease of comparison. Here comparison means comparing our economy with other economies. So comparing economies globally. Global comparison. Comparing Indian economy with that of other developing countries' economies or developed countries' economies, etc. Another reason he gave was that global performance of economies are gauged in terms of GDP. So global performance can be measured. Another reason he pointed out was that multinational institutions, international analysts and investors use GDP for their calculations. So multinational institutions like the World Bank, IMF, etc. So multinational institutions, international analysts, investors, etc. use GDP. So this is an internationally accepted norm, GDP. Again, another reason he pointed out was that CSO or Central Statistical Office also uses GDP to measure economic growth. CSO uses GDP to measure economic activity or growth. So these were the reasons pointed out by the Deputy Governor to shift back to GDP. This is an important current affair. Please have a clear understanding of this topic.